The artificial intelligence boom has spent years pushing chip stocks higher, attracting hundreds of billions of dollars into data centers and convincing investors that demand for computing power could keep rising almost indefinitely. Then, in a single trading session, some of Asia's most important semiconductor companies lost more than 10% of their value. Samsung Electronics fell more than 13%. SK Hynix dropped almost 15%. South Korea's main stock index plunged so sharply that trading safeguards were triggered. Japanese semiconductor shares also fell, while Nvidia had already dropped in the United States. This was not caused by one failed product or one weak earnings report. Investors were suddenly confronting several risks at the same time. China's progress in semiconductor manufacturing, the enormous financial commitments required to build AI infrastructure, and growing doubts about whether current spending can produce enough revenue to justify its cost. The sell-off may eventually prove temporary, but it exposed a change in the AI story. For years, the dominant question was whether companies could obtain enough chips. Now, investors are starting to ask whether the industry may be building too much infrastructure, borrowing too much money, and underestimating how quickly Chinese competitors can enter the market. The first warning came from China. Reports suggested that a Chinese state-supported company had begun producing domestic deep ultraviolet lithography equipment. Lithography machines are among the most important and complicated tools used in semiconductor manufacturing. They project tiny patterns onto silicon wafers, helping create the circuits inside processors and memory chips. The most advanced chip factories depend heavily on equipment from the Dutch company ASML. Its extreme ultraviolet systems are essential for leading-edge production, while its deep ultraviolet machines are widely used for many other chip-making processes. China has spent years trying to reduce its dependence on foreign semiconductor technology. American export restrictions were designed to limit Chinese access to advanced chips and manufacturing equipment. The assumption was that controlling those tools would slow China's progress. A domestic deep ultraviolet machine does not instantly place China ahead of ASML. It does not mean Chinese factories can suddenly manufacture every advanced processor efficiently. Semiconductor production requires an entire ecosystem of optics, chemicals, software, inspection equipment, materials, packaging systems, and engineering experience. However, the development changes expectations. Deep ultraviolet systems can be used to produce mature chips directly. With more complicated multi-patterning techniques, they may also help manufacture smaller features, although the process becomes more expensive and difficult. If China can produce more of these machines domestically, its manufacturers become less vulnerable to foreign restrictions. They can expand capacity more aggressively, improve their equipment through real factory use, and gradually replace imported tools. That possibility placed pressure on ASML and other chip equipment companies. It also created fear across the memory industry. Memory chips are essential for artificial intelligence. Advanced accelerators require high-bandwidth memory to move enormous amounts of data quickly. SK Hynix, Samsung, and Micron became major beneficiaries of the AI boom because demand for this memory rose faster than supply. SK Hynix became especially important through its relationship with Nvidia. As AI data centers expanded, investors expected high-bandwidth memory demand to remain strong for years. But memory is historically a cyclical industry. When prices rise, manufacturers build more factories. Those new factories eventually increase supply. If supply grows faster than demand, prices can collapse. China's Changzin memory technologies, commonly known as CXMT, has become a serious source of concern. Its stock market debut increased attention on China's ambition to become a major memory producer. If Chinese companies expand production using more domestic equipment, the industry could face greater competition and possible oversupply. This does not mean SK Hynix or Samsung will immediately lose their technological leadership. High-bandwidth memory is difficult to manufacture. It requires advanced packaging, precise stacking, high yields, and close coordination with accelerator companies. But markets react to future expectations, not only current performance. The possibility of more Chinese supply was enough to make investors question whether today's exceptional profits can continue indefinitely. The second warning came from the financing behind the AI boom. Nvidia is reportedly discussing a financial guarantee of around $250 billion connected to a massive OpenAI data center project in Ohio. The proposed site could require 10 gigawatts of power and cost more than $500 billion over time. The guarantee would reportedly help support OpenAI's lease and infrastructure financing. Nvidia is also said to be discussing additional financing connected to OpenAI's purchases of Nvidia chips. No final agreement has been announced, and the structure could change. But the scale of the discussions shocked investors. Nvidia's success comes from selling the processors required to build AI systems. If Nvidia also helps finance the customers purchasing or using those processors, the relationship becomes more complicated. This is sometimes described as vendor financing. A company supports its customer financially so the customer can continue buying its products. This can accelerate growth, especially in industries where equipment is expensive. But it can also create circular relationships. The supplier records strong demand because the customer keeps expanding. The customer keeps expanding partly because the supplier helps provide financial backing. If the customer later struggles to generate enough revenue, both sides may be exposed. That does not automatically make the arrangement dangerous. Large infrastructure projects often involve guarantees, partnerships, long-term contracts, and complex financing. The problem is scale. AI companies are planning infrastructure projects comparable to power grids, industrial zones, and national transportation systems. These projects require land, electricity, cooling water, chips, networking equipment, construction, and debt financing. The cost arrives before the revenue. A data center may take years to build. The AI models running inside it must then generate enough income to cover electricity, hardware replacement, interest payments, maintenance, and software development. OpenAI has enormous user growth and strong commercial momentum, but frontier AI development remains extremely expensive. Investors are therefore asking how much future demand must materialize to support infrastructure commitments measured in hundreds of billions of dollars. The third warning is that AI itself may be becoming cheaper. Chinese open-weight models such as DeepSeek, Qwen, and Kimi are competing by offering strong performance at lower prices. Businesses can sometimes download these models and run them on their own infrastructure. If models become more efficient, companies may need fewer high-end accelerators to perform the same amount of useful work. Better software, lower precision computation, mixture of experts' architectures, and improved inference techniques can reduce the computing required for each response. This creates a complicated outcome for chip companies. Cheaper AI can increase total demand because more people and businesses can afford to use it. At the same time, efficiency improvements may reduce the number of expensive chips needed for each task. The industry is betting that usage will grow faster than efficiency. That may happen. AI is expanding into coding, search, advertising, medicine, robotics, scientific research, customer service, and office software. Billions of daily interactions could require enormous computing infrastructure. But investors are starting to consider the opposite possibility. What happens if models become much more efficient before AI revenue grows enough? What happens if companies discover they can use cheaper chips, smaller models, or Chinese alternatives? What happens if data centers are completed just as demand begins growing more slowly? These questions explain why the sell-off spread so quickly. It was not simply fear that one Chinese lithography machine would replace ASML. It was not simply concern about one Nvidia financing discussion. It was a broader reassessment of the assumptions supporting the AI investment cycle. Those assumptions include continuously rising chip demand, limited competition, high pricing power, easy financing, and rapid growth in AI revenue. When several assumptions are challenged at once, highly valued stocks can fall rapidly. This does not prove that the AI boom is ending. The largest technology companies are still spending heavily. Nvidia continues to dominate advanced AI accelerators. SK Hynix and Samsung remain central to the memory supply chain. ASML still controls technology that competitors have struggled for decades to reproduce. China's domestic chip-making equipment also faces major technical challenges. Producing one machine is different from operating thousands reliably inside high-volume factories. Yields, maintenance, precision, throughput, and integration will determine whether the equipment becomes commercially important. The market may therefore have reacted more strongly than the current evidence justifies. But even an exaggerated reaction can reveal real anxiety. Artificial intelligence has reached a stage where the technology is no longer separated from energy policy, debt markets, international trade, and national security. Building the next generation of models requires more than better algorithms. It requires power plants, financing structures, global supply chains, and political support. Every part of that system creates a possible bottleneck. Electricity can become too expensive. Governments can block equipment exports. Memory supply can grow too quickly. Customers can delay projects. New models can reduce computing requirements. Lenders can demand higher interest rates. The AI race is therefore becoming less predictable. For investors, the lesson is not that every chip company is suddenly in trouble. It is that the easy part of the AI trade may be over. During the early boom, nearly every company connected to GPUs, memory, networking, power, or data centers benefited from the same story. More AI meant more infrastructure, and more infrastructure meant higher revenue. The next phase will demand greater differentiation. Some companies will maintain technological advantages. Others will face price competition. Some data centers will produce strong returns. Others may be built in the wrong location, with the wrong financing, or for demand that arrives later than expected. China will remain both a customer and a competitor. Export controls may slow its progress in certain areas while accelerating domestic alternatives in others. The sharp fall in Asian chip stocks was not proof that the AI bubble has burst. It was something more useful, a reminder that even the strongest technology trend can become dangerous when expectations rise faster than certainty. The AI industry is still expanding. But for the first time, the market is seriously asking who will pay for all of it, who will control the equipment, and whether today's winners can remain winners once China, cheaper models, and massive debt enter the same race.